Hi, everybody. Great to see you again. And wonderful to be up here with these private equity titans. It has been really a wonderful moment in time for private equity, as you all know, and we want to talk about what's behind it and whether or not it continues. So let me introduce our panel here. And as you can see, we've got Leon Black, Chairman and CEO, Apollo Global Management, David Bonderman, Founding Partner, TPG, John Donakiel, Managing Partner, Leonard Green and Partners, and Jonathan Nelson, Founder and CEO, Providence Equity Partners. We know that we are very much well into the realization process of private equity, where we're seeing huge gains in terms of IPOs, sales of companies, and there is a whole host of good things happening here, lots of liquidity swashing around. So, Leon, I'd love you to kick us off, since we know that you just finished raising a fund. It was quite successful. Your performance has been terrific. Can you walk us through the process, what you saw as you were raising money for this most recent fund, so that we can get a good idea of the reception for private equity today?
Okay, Maria, great to be here. I only do this now. It has nothing to do with Mike anymore. It's just because of your leading this
Thank
and
you so
moderating
much.
this. So,
David?
the process is the one that we all know very well. We sort of go out with our cup in hand and say, please, please, and hope for the best. But, I think for Apollo, we had a very good experience last year. And I think it was based on, one, having a differentiated story. We are a value investor that is able to traverse market environments, and had some good fortune in the downturn that had occurred in 08, 09. And the other lucky thing that we had, I don't know if some of you were here last year, I was infamously quoted as saying that we were selling everything that wasn't nailed down.
That went viral last year.
And that went viral. And that, in fact, is what we did. And so investors happen to like realizations. It was the first time the last 2 years that the public markets were cooperating after 4 years of inactivity. And so there were a lot of ripe and ready companies to be sold, and I think the whole industry basically took advantage of that. You had dividend recaps, you had strategic M&A sales of various portfolio companies, and most importantly, you had a very robust IPO market. And I think in 13 alone, we took 11 of our companies public at that point. So between the differentiated story and the realizations, we fared well and raised a good-sized fund. I'd say, looking at it from comparing it to other vintage funds, clearly there was even a larger international participation among LPs. If 10 years ago the US was probably 2/3 of our fundraising, now I'd say it's closer to 40 to 45%. Clearly both the Mideast and the Far East have both stepped up, especially many of the sovereign funds and other institutions there. So.
I think that now concludes our discussion.
Well, this sets you up, because I know, David, you are also about to be going out with cup in hand. So given this market performance, is it more important to see a robust environment in the public markets when you're at this point in terms of about to raise money for a new fund? You also have other things that are happening, like the regulatory environment and like certain special situations, which I want to get your take on.
Well, I think that raising money, whether it's for Leon's firm or John's, Leonard Green Partners, or Jonathan Nelson's Providence, or ourselves, I think it's everybody's least favorite part of the job. Sort of reminds you of Peter Sellers in Pink Panther. He's with the organ grinder on the corner, and the monkey's doing the organ grinder, and his famous line was, he does not tell me what to do with the money, and I do not tell him what songs he should play. So we're out all playing the same song. Leon's got his shtick, which you just heard 10% of right there.
You guys are always so competitive
Another
with
90.
each other. This is really...
John Donahockle has a different shtick. His firm's done great.
What's your shtick?
My shtick is getting to make fun of both of them. And that concludes my presentation.
Jonathan, is it most important to have a vibrant public market, or are you seeing the regulatory environment also contribute to helping opportunities? Because you've got so much business that the banks are no longer able to do. Much of that business is coming toward this industry.
Well, we're in two businesses. We're probably better known for our private equity business. And then there's the credit side, and the response to your question varies depending on which side of the house we're talking about. On the equity side, I'd say increased regulations have had and will have, in my view, zero impact on returns. It will increase our costs, but it won't affect returns. And indeed, I don't think it will alter the course of our business. On the credit side, it would be a very different answer. I'd say the regulatory environment, which seems to be on a track that is going to continue for as far as any of us can predict, I think, is really our partner. It has enabled many of us to step in and replace the role that traditionally was held by banks. So in a sense, it's actually been a wonderful thing for us. And indeed, we're playing a vital role in helping companies grow. They need capital. And if they can't, for typically regulatory reasons, to get it from banks, there are private sources that are stepping in and doing, by all accounts, a very good job. So I think there's nothing to complain about on that score. We're happy for it.
But in terms of the private equity part of the business, there are special situations that you have a specialty in: cable, media, telecom, education. You've got the biggest deal, I guess, this year in biggest deal in the space, Time Warner Cable and Comcast about to happen. How does that change the landscape? Do you think the deal goes through?
Yes, I do. It's actually a very big week or month in media, where we focus, media and telecom. The Comcast deal, which I think Comcast has smartly framed the regulatory argument around, it's pro-consumer. It has either zero or a positive effect on competition, as they define it. And I think they're right to make the case that way. They're very good. I think consumers will win. If you're a Comcast subscriber, you're a happy subscriber compared to competitive offerings. They do a very good job. It's a good company. What's interesting to me, is the second order effect. What will happen to content creators? Privately, they all have to revisit what constitutes scale, because their most important distributor and their most important market just grew, or assuming it goes through, and they will need to respond to that, I think. So that's very interesting. And then, of course, there's the whole broadband impact and what's going on, because the backdrop is that we've got consumers moving into, particularly millennials, which would be probably no one in this room, that is those who are born after 1980, who prefer watching television, not on a TV, but on a tablet. That's a big issue. So there's that, yes, so that is, we'll be living with the impact of this for 5+ years. The other big issue today which is definitely a legal one, it's literally before the Supreme Court as we sit, is Aereo. And
Aria.
and that's binary. They're either going to allow it or disallow Aereo's business. If they allow it, then you have probably $2.5 to $3 billion of pure profit to the networks evaporate. That is their EBITDA. I don't know any more than next. We actually had someone in the court listening to the oral arguments, and I'm inexpert at reading the tea leaves of justices, but the Chief Justice did say, that he could see no technological reason to array 10,000 antennas, each the size of a dime, except to circumvent copyright laws. That sounds to me like they're going to disapprove it, which I think would be a good thing.
Mm-hmm. We'll touch on some of the specialties that we have up here, but why don't we put up slide 1 to show really the U.S. private equity deal flow as we're talking, and throughout all of this, the backdrop is an economic climate that seems to have gotten better, John, and you are focused on the consumer space, healthcare, and of course business space, but let's talk about the consumer space for a moment. You've acquired a number of leading retailers. How would you characterize sort of the backdrop with which to invest from the consumer space?
Okay, well, thank you, Maria. It's interesting because certainly the press right now sort of suggests the world's a better place or America's a better place. What we found with our portfolio companies through the recession was that they actually did quite well. The measure that sort of commonly cited is same-store sales, and our same-store sales growth have been, positive certainly since '08, every single one. For the first time this year, we're actually finding things slowing, and we're scratching our heads as to why. If you look at the economic statistics in terms of GDP or per capita GDP, things look better. There's this sort of issue of weather, which is really, it's thrown a lot of retailing out of phase. So those people who sort of expected to sell things at full price early in the season ended up having to sell them at 30% off later in the season. So that's a concern. And then, of course, the other concern is the internet. And, people are going outside or not going outside. They're basically shopping from the comfort of their own homes and having goods delivered to them. And that does impact retailing, but conventional retailing, but all good retailers are reacting to it. So they all have their own internet businesses. They're all competing. So I would say that, at least from what we can see right now, is probably about as uncertain a time as we've seen in the last 3 or 4 years. Wow,
from an economic standpoint.
Just from a sort of a consumer engagement with traditional retailing standpoint.
Even as interest rates are at rock bottom levels. David, you wanted to also touch on what the public markets has meant for this deal flow in private equity.
Well, there's a symbiotic relationship between private equity and the public markets. Obviously, we're an alternative form of capital, tend to be a more expensive form of capital, but we also use private dollars to withstand bad periods in the market. So if you look at buoyant markets, as Leon's famous quote that he mentioned before, is right. When the public markets are very buoyant, you want to be a seller. When the public markets are in trouble, you want to be a buyer. So for us, we were the world's largest private equity investor in '09, '10, because we liked the vintages coming out of the depressed era, and we have been 6th or 7th and largest in the last couple of years because as prices have risen, we have liked the market less. Doesn't mean it's bad, but there is this symbiotic relationship.
Less opportunity, sure.
I'd like to also, interest rates are historically low right now. What that really means inverse relationship is that prices are very high. Money is incredibly easy. Institutional memory doesn't exist, as we all know in this room. Covenant light is back fiercely, and it's still, in our view, not a robust environment for private equity. Multiples are at about 9.5 times for deals over times EBITDA for deals over 500 million. In Europe, inexplicably, with the lower growth rate, they're even a half a multiple higher. So there's a lot of easy money around, low interest rates, very full prices. And just following up on David and my comment last year, we are continuing to sell more than we are buying. If you look at the last 2 years at Apollo, we put about $3.5–4 billion to work in private equity, and during that same period, we had realizations of $26 billion. If you look at the first 4 months of 2014, in our new fund, we've done 3 deals, and that's about $850 million that we've put to work. And during that same period, we've continued to sell down about $3 billion. So it's almost a 4 or 5 to 1 type of ratio, given the easy money, high-priced environment. Still better time to sell than to buy. Now, there are exceptions to that. There are always deals off the beaten track. That's what we try to do at Apollo as a value investor. That's why we buy things like Chuck E. Cheese, because we're getting a high 6 multiple on it. And there are also certain sectors, and you talked a little bit to Jonathan about media, but clearly the whole energy and natural resource area is an area today where there are more opportunities than there is capital. Frankly, the shale revolution is very, very real, and that has a lot of impact on upstream, midstream, and downstream opportunities. So that's one of the areas you look at. The other is the deleveraging of the banks, especially in Europe, and there are opportunities in the FIG area today. But in general, we think it's a very high-priced environment.
So I heard many of you talk about the shale revolution in the U.S. as being a real opportunistic, and we want to talk about Europe, particularly as the banks continue deleveraging in the financial industry there. We could look at 17, 18, and 19 in terms of slides, because what you said is the fact that given you are all private equity, you can sit on cash. You don't have the pressure in terms of needing to put that money to work if things have actually gotten expensive, which is what we're seeing right here in this chart, global private equity dry powder.
So if this is interesting because, or what may follow, I haven't seen this before, but first of all, what Leon described, and he does it as no one, I don't think, does it better than Leon, actually mirrors, I think, what's happening across, on average, private equity. If you look at the inverse, the institutions that supply most of our capital, for 3 straight years, the distributions they've received have exceeded their commitments. And we have also been harvesting everything we could that made sense, and we're finding good deals to be scarce. Because I think in this environment, while generally institutional memory doesn't seem to be prevalent, most of us want to be very careful with the capital we have and not repeat mistakes made before on the eve of the last crisis. But there is good news in the dry powder, which actually doesn't show up on that slide, which is that one thing that has happened over the last couple of years, despite the scarcity of deals, is that we've worked off the oldest capital committed to our sector. So while dry powder has increased around the world, And its ratio of what you're investing is also important. It's not just dry powder, it's what's the rate it's investing, because that ratio determines the fierceness of our competitiveness and values privately. But today, 80% of the capital committed to the folks like us at this table is fresh. It was committed after 2011. And that's a big difference, because the oldest capital has the highest pressure to put to work. It's use it or lose it.
That makes sense.
Which is very dangerous. And so I think that's been cleaned up. The other aspect about dry powder is it really varies around the world. Emerging markets is the only space, and this does not portend good news, I don't think, for investing in emerging markets. It's the only region where it's above the peak dry powder we saw. So it is increasing faster than deals, and faster than Europe, and faster than the US.
Cash is.
Dry powder, especially if you adjust it for activity, investments, which I think in our world, supply and demand of deals and capital has a lot to do with returns.
I'm glad you brought us to the emerging markets, because this is an area, David, that you've looked at for a long time, and Jonathan, you are interested in as well. And the pain has continued in the emerging markets, with the exception of the last month or so, where you're seeing in the public markets outflows in emerging markets. What is it going to take, do you think, to realize the value that you have identified, and you have identified in the emerging markets?
Well, there's just a couple of points that ought to be made. First of all emerging markets are not created equal. Some markets none of them have been favored in this kind of situation, because when people worry about capital preservation and the fear factor overcomes the greed factor, people tend to want to invest in the United States and developed countries. And when the reverse is true, i.e. people get tired of low interest rates and low returns, they tend to flow into emerging markets, which are higher growth. And we've shifted between those two poles. I would say that the other thing you have to keep in mind is, as private equity investors, you cannot do what the public markets do. You can't flow money in and out easily. If you bought a coal mine in Outer Mongolia, you're going to be living with the coal for a while, whether the market goes up and whether it goes down. And so you better have a long-term view on currencies and on the sector and on the politics, and things can come out of left field. And so you have to be prepared for that, but you can't be thinking you're going to be shifting back and forth very much. The other thing is that these markets tend to be, if anything, more volatile. If you look at China, which was once everybody's favorite, the PEs were in the 30s. The Chinese public markets have been the worst performing public markets for 3 years in a row, and the worst performing markets in the world over 5 years. PEs are now 7 and 8. You have to take a view that maybe if you loved it at 30, you might like it better at 7.
Right.
Whereas the basic world tends to think the other way around.
Mm-hmm. You know, I agree with David's point about not every emerging market is created equal, and it's very idiosyncratic. We don't invest in coal, and we don't invest in Outer Mongolia.
Well, you got started in the right place.
So, which seems like a good place to start with an investment allocation. But what I do think,
they're focusing their attention on the Ukraine.
But it's interesting to me, and to be provocative, although arguably not very smart, to offer a view that's contrary to the mainstream of the investor population, which is embracing, generally, you can see it in allocations, emerging markets. I think it's the next great disappointment. Actually, if you look at the returns on emerging markets, if you look at 1 year, 3 year, 5 year, 10 year, 20 year, emerging markets underperforms developed markets. That's without even adjusting for risk. One would expect the opposite, higher risk, higher return. And you don't see that in the numbers. Now, maybe something is going to change that, but we haven't seen it yet. fact, the recent history actually confirms what we're seeing. What I think is going on, we talked to many of our investors, which I think represent a cross-section. First of all, it's understandable. It's about asset allocation. Investors feel underexposed to emerging markets and overexposed to low-growth areas like the Eurozone or even the US. And what it's about is GDP growth. It's clearly, even the revised Chinese numbers, it's below 8 now, and that's still eye-popping to an American or a European.
Well,
it's
we
great.
have an economy in contraction or
Right.
an economy at 2%.
Right, but in our world, and GDP growth is uncorrelated with return on equity. And that's, I think, the missing link. And it's certainly not risk adjusted. In fact, for a dollar-based fund, it may be inversely correlated. That's what the numbers suggest. So what I'm saying is that that these allocations have now burdened those markets with so much capital that when you factor in the country risk, FX risk, governance, law, capital markets, the sophistication and breadth of them, one would expect a much higher return, and most of us struggle if we adopted the same standards at approval of investments in emerging markets, we actually wouldn't get anything done. It should be aiming for much higher returns than what you see in Europe and US, and it's not clear that that's happening.
That's interesting. Do you agree with that? That the economic growth of a country does not necessarily mean investment returns?
Well, I think Jonathan is sort of half right. Truth of the matter is, we invest in.
I'll take that.
It's the best you're going to get. Half right in the sense that we are investing in companies, not in countries. And so we don't invest in GDP growth, you invest in earnings growth. And while they may or may not be correlated in particular places, they're not the same. That's the first thing. The second thing, the statistics that Jonathan mentioned are correct but misleading, because the equity returns in developed markets tend to be leveraged returns. And so somebody reports, Leon reports, I report, John does, that they earn 25% in some investment on the equity piece. Likely that business is leveraged somewhere between 3 to 1 and 10 to 1, depending on the nature of the business and so forth. So it's you're taking leverage risk. In most of these emerging markets, there's no debt, and you're not taking any risk on the capital structure. You're taking political risk, you're taking currency risk, you're taking other kinds of risk. But the numbers are not comparable. So yes, Jonathan is right in principle. On an apples-to-apples basis, you should expect in a riskier market, if you're going to do it, you want to have higher returns than in a less risky market. But the statistics are not exactly on point.
You want to add to that, Leon?
Yeah, I would just say that in our experience at Apollo, a lot goes into, there are many ingredients that go into making a good private equity investment. And it ranges from good management and to barriers to entry and market share and a good brand. And we all know the laundry list, but and that's what due diligence is all about. But to us, we just have felt over time that the single most important ingredient is price that you pay. Yes, it has to be a good company, but price is the key to outcome. And that's why our view has been as a value investor. I mean, we've done very well in terms of returns, but frankly, what I'm most proud about in our track record is that we have paid very low multiples. Our last fund had great returns, but we paid a 6.1 multiple. That's why we're not very involved in the emerging markets. And because the emerging market play is not a value investment play. You pay a high price in the hopes that you will get out at an even higher price. And for many, that works. And it works oftentimes because of growth rates as well as a whole bunch of other ingredients. But our feeling has been with the emerging markets, we have two strikes against us. One, we're a value investor, and that's not what emerging markets are about. And the other is that a lot of deals, not all, you need to have a majority partner, and you're really a minority partner. And our view has always been that that's fine when everything's working out well, but if you're a big believer in Murphy's Law, as I am, when things go wrong, and especially if it means wanting to change management, if you have a majority partner that disagrees with you, you're stuck. And that's a problem for us. So we do very little in the emerging markets, with the one exception is that we are very involved in India, where we have a joint venture with the largest local bank there, ICICI. But again, it's not for the growth play. We're mostly focused on stressed situations of over-leveraged companies that need a restructuring.
We're going to come back to the U.S. and Europe in a minute, but for the EM guys and the emerging markets here, Russia is an emerging market, so it's hard to look at, like you said, the block as a block because each has its own mentality and situation. Which emerging markets do you think are best positioned, knowing that it's not necessarily correlated, but if you were to look for earnings growth, if you were to look at strength in terms of emerging markets, don't look at them as a block. What one or two or three countries do you think are actually best positioned?
Well, some of the best positioned countries are ones that people don't think of. There does tend to be a rush of capital. Things tend to be the flavor of the month. Africa is hot now. We don't do anything there, but if you go talk to LPs of the world, they all want to be in Africa this week. So that probably means it's a bad place to invest. But we've had the best success in markets which are what you might think of as occasional markets, like Vietnam. We've done 3 deals. They've all been highly profitable. Indonesia. But structurally, the economy that everybody wants to watch and should be watching is China, to see whether they're capable of making a transition to a more consumer-driven economy, and whether they're successful in moving up the value chain and not trying to compete with Bangladesh for low-priced textiles and things like that.
You have a favorite emerging market?
I have
I mean, Mexico
a group.
has been
Yeah, I
one.
wouldn't disclose
Indonesia.
it because then the David Bonderman rule would probably ruin it if other people thought it was such a good idea, because David was half right about that.
Well, that's an improvement of 50%.
The way we look at it is actually there's probably a set of countries, better not to list them. I don't know how many people are actually tweeting as we speak here, that are off limits by our choice for us. We just think either life's too short, risk is too great, we'd never be compensated for it, there is no law, the currency, whatever that's on the list, forget it. Don't come to investment.
What's that list?
Excuse me?
What's that list?
I'm unwilling to share it.
Okay,
Because I do travel all over the world.
I understand.
Then there's a group of countries that it's all about the company, our partner, and we will take a serious look and when I think about the last 6 months, we've been active in Indonesia, Sub-Saharan Africa, notwithstanding David's comments. We've been very active in Brazil, and it's worked out well for us. But it's really situational. It's not based on so much a macro view, but a micro view.
John, you have boots on the ground in all of those countries?
We have offices in India, Hong Kong, Beijing, yes. So we're committed to the region, although I would...
But Brazil, Africa?
No. Africa covered out of London. And for us, it's a matter of let's see how flow develops. Because one of the patterns we've observed is, and it's a balancing act between local presence on the one hand, which sounds like a very good thing once you've made an investment, and the natural tendency of a home office to want to promote its deals. And then once you've made a commitment, you tend to tilt towards that country rather than being impartial, agnostic about where you invest because you've made a commitment. And this is actually, you see a pattern with home offices. And if you talk to the parent, chairman of an investment committee somewhere, he said, oh my gosh, here comes a team that hasn't done a deal in some part of the world in 3 years. I'm not sure this pro forma is meaningful. So that's kind of the inside baseball of what's going on. But there's in that group of countries that we're interested in, it varies over time, but in the end, you can never escape good company, good partner, and that's what's critical.
Sure.
So I agree with David on that.
So just as a student of these sorts of things, I think there's the biggest risk in this sort of activity is we take our experience base here and we go to some place and we don't really know. So for example, 8 times EBITDA here, what does that really mean in Brazil? What does it mean in China? Is it appropriate? Is it inappropriate? Is it high? Is it too low? To Leon's point, I think what you just described is the reason we've stayed away from it entirely, because we don't feel like we can assess the risks at all. And the point that you just made, which is an interesting one, and I've seen this again and again, you're really talking about a challenge of management, on a global basis of a firm. So being able to me, the challenge of being able to make good decisions on investments in Africa from an office in London by a firm headquartered in New York, to me that would be insurmountable for me. But that's my own management
right.
competence.
So using the Bondo's grading, I think you're 20% right.
Better than usual.
No. Actually, the piece. By the way, I completely agree with you. For a generalist firm,
yeah.
The difference when we looked at strategies of different firms and what would be appropriate for us is we are highly focused on media and communications. And wherever we go, the first point we say is, will our expertise be valued? In other words, if all we're doing is supplying capital, I completely agree with you. But if it's perceived, if it's acknowledged that we can bring IP that they don't have, not capital, and it will be valued, then we're eager to be there. So, for example, in China, we partnered with Baidu, the Google of China, because they saw what we did with Hulu when we started Hulu in this country and said, we need that kind of help to build a streaming business that today is a very big business. And that was very interesting to me because it meant that arguably one of the most powerful companies in one of the most important industries in China reached all the way around, halfway around the world and said, we value your expertise and we'd like you to be our partner. Mm-hmm. Which I would not have predicted, by the way. There are many important economies that someone that powerful would acknowledge an expertise that they needed, in this case from an American group. So that's why we feel comfortable knowing all these risks. If we think that we can't help a company, by the way, this is a global standard, we're not interested in investing. If they just want capital, they should get it locally or from someone else. But if we have something to offer because of our experience, because of our reach, it could be about content partners, because they want access to media content. whatever it might be, or a relationship with a big MVPD cable company, that's what we're drawn to. And otherwise, we're not. In India, it's no accident that we're in the largest tower company and a national mobile phone company, because they saw something that they value. Otherwise, we shouldn't be there.
Yeah.
And I completely agree with you.
Well, that's a great point, and that's your expertise. Let's bring it back to the U.S. and get into Europe a little. And John, talk to us about the opportunities that you're seeing in the U.S. And despite the fact that we are seeing valuations where they are in the public markets, you've been able to find hyping opportunities relative to telecom. You've been able to find opportunities, obviously, consumer-related. How do you see things?
Well, it's interesting because it sort of shows there's different ways to skin a cat, and you know, Leon has done an amazing job. Apollo's done an amazing job of basically being, you know, as Baron Rothschild said, investing when there's blood in the streets, and basically putting capital to work at the right time, at the right multiple. We have a different philosophy. And it's sort of a combination of what we call sort of the Jack Welch. We want to buy an important company, one or two, and Peter Lynch. We want a business, the EBITDA of which will grow 50% or more over our whole period. And what we found is if we can find that company, if in fact that company does what we think it'll do, price sort of doesn't matter, and it certainly doesn't matter on the margin. We'll make money. The only question is how much money will we make? So our emphasis has been, and our returns are relatively speaking comparable, but our emphasis has been completely different. So sort of given that background, and I think, David, you sort of started out with saying it's not a market, it's a market of companies. There are things to buy. What we have found lately is that the most interesting set of opportunities has basically come from private equity brethren. And it's because of the point that was made by our folks at that side of the dais here, which is that we are in a business of returning capital to our partners. And the easiest way to return capital to our partners is to sell our best companies. So what we're finding, and what we've been finding for the last 2 or 3 years, is that the best companies have been for sale. And through traditional auctions, that's probably been our sort of most attractive opportunity set. So we've bought, I think every company that we've bought in the last 2 or 3 years has, via an auction from another sponsor, has outperformed whatever projections. Many of them have been recapped. We've gotten capital out in part, sometimes in full, sometimes more than in full. So that's sort of right now the opportunity set that we see. That being said, it's being played out. So the good ones got sold early, the second good ones got sold second, and we're now kind of in sort of the third generation, and I would say that this opportunity set to some degree is diminishing.
So much of the easy sales have been done, and it sounds like you all agree that it's right now wise to sort of sit on cash a bit because things have gotten expensive in the U.S. What changes that dynamic?
Well, I just say the comments made are pretty illustrative that there's more than one way to skin a cat. So you've got Jonathan over here, Providence, outstanding firm, more or less exclusively in the media business, very specialized. You've got John, who has a retail focus, but has this great investment philosophy of never invest in a company you can't reach from the 405 within 15 minutes. So
That's true.
While Jonathan's got offices in India and Leon's worried about ICI and we're doing deals in Vietnam, he's doing deals in Santa Monica, which certainly saves on the jet fuel.
I can't handle Chinese food. It's
So there's many ways to get to the right answer. The only point I want to make is that even the firms that Jonathan Nelson refers to as generalists are not really generalists. If you look at Leon's firm or our firm, we all have sectors in which we specialize, whether it's a retail and consumer phase or it's a telecoms or whatever it is. Generalist firms don't succeed because you do, to the points that the guys were making, you do have to have a view on management, you do have to have a view on operating the company, and if you can't help a company get better, you're just capital, and we are expensive capital. You want to be in a position to help your companies do better, and that's what John's guys do well. That's what Jonathan's guys do well in the media business. Leon's guys do that with a focus on debt. So people have different ways of getting at it, but you don't succeed without bringing more than capital to the table. Capital is cheap, and private equity is not.
Yeah, I think that's a great analysis, actually. And you know, then there are those opportunities that are just opportunities that, regardless of what you are special in, you may see something and say, well, wait a minute, this is not going to be up for sale again. Let's stay local on that point and talk a bit about something that is happening very local right now, and that is the racist comments from the owner of the Clippers. You have been
That's
investing.
what that note was about.
Yeah, that you've been
We're against
investing in sports before. Would you look to buy the Clippers if that goes up for sale?
Let's see. Well, we actually, just to set the record straight, it's actually the fourth time that has come up in the 36 hours I've been here.
You think he's going to be forced to give up the team?
Excuse me?
Is he going to be forced to give up the team?
One would hope. It was, I actually did listen to his comments because it was when it spread like wildfire. And it's a new commissioner, and actually they're announcing it this afternoon. Did they? Banned for life.
Oh, that really?
Oh, okay, that seems
Okay.
long enough. So,
Wow. Yeah. Okay. So we thought he would be banned.
good.
At 80-something, it
No,
may not be that
I
long.
think-
It was actually quite
Excuse me?
At
extraordinary.
80-something, it may not be that long.
Yeah, well, it should include his family. It actually it really was shocking. But if we get away from the moment here, and particularly in LA, think about it from just the perspective of sports, because we care about that as a business.
Right. And it's
There
big
is
business.
nothing, if you think about content and what we consume, even in tablets and smartphones, there is nothing close to the value of sports in this country, and indeed, it's a global phenomenon. There is, if you looked at the top 20 shows in the US last year, all of them would have been an NFL football game. There is nothing close. So if you're in basketball, everything is, football is way out in its own, but then you get to basketball and baseball and hockey, et cetera, soccer, and the impact it has and the value. I think we literally have networks whose foundation, you work for one, is sports in the end. So when there is an owner of a team, think about any other business owner of a team that size making just inexcusable, stupid.
Marge Schott did the same thing, right?
Marge Schott. But the reason we know Marge Schott's name is because she was a baseball owner. What I'm saying is if they owned some other business, if it was just whatever real estate business he had, no one would care except his
I see
employees.
what you're saying, yeah.
But the fact that it's a national sports league, it cannot be tolerated because everybody now is aware and concerned, and it means something. By the way, why is sports is special? Well, first of all, it's always live. And there's very little that we consume today that's live.
You're not going to see Netflix having sports.
Because the value of a game diminishes immediately after it's over. You want to watch it live when the rest of the community does. And it's now...
Except if you're watching the Olympics.
Excuse me?
The Olympics is taped, right?
Well, a lot of people streamed it. In fact, there is, if anything, there was a concern that might reduce ratings. It actually enhanced it. The shows that were streamed were even more popular. And that trend is going to continue. I mean, most people watch shows, not necessarily this crowd. They're multitasking, they're tweeting as they're watching. Most tweets, by the way, are about sports. It's really very interesting. So that's, as investors here, while it was he got what he deserved.
So you would like to see the team be up for sale?
So,
Bottom
yes.
line.
Can I? Here's the challenge. I don't think the rhythm of our business That is, deploying capital over 5 years, harvesting over 5 years, lends itself to the ownership of professional teams, because you sell them when you sell them to they're sort of magic things to sell at points in time. So I could see people in private equity or people in money management business buying the Clippers. That's probably, or having an investment in the acquisition of the Clippers. But I think it'd be pretty unlikely to see a buyout firm buy it.
Right. By the way,
imagine.
I'm glad you made that point, because I interpreted Maria's question personally buy it, because that's what we've seen. I think it's inappropriate for a fund to buy a team.
Yeah, okay.
And so that's how I
That's
was
what I was
thinking
asking,
about.
but you're right. No, that's a very good point.
By the way, the leagues wouldn't be exactly thrilled to have a corporate owner either. If
Yeah.
you look at the pattern of ownership,
Right.
it's all wealthy individuals.
Right.
It's the only sector in America which is not corporate at all, not dominated by the Comcast of the world. It's dominated by individual owners.
And is it profitable?
I don't know if I would agree entirely with that, because if you look what happened with the Dodgers, with Guggenheim, it was
right.
all,
I was just going to say, tell Google
all
that.
based on the cash flows of the network contracts, which I would have agreed with the statement 10 years ago or 15 years ago, because it's all based on terminal value and you weren't seeing cash flows. But I think more and more it's all about the television contracts and the cable contracts, and which you can take to the bank and you can leverage also.
Right.
So I think there's some change going on.
Yeah, so I agree with Leon, but there is an approach that we've taken, which I think is appropriate for both the industry, our investors, but capitalizing on what we think is that piece which best fits, which are the media rights. So, for example, with the Yankees, we bifurcated their media rights from the team, bought their media rights for 25 years, and started the Yes Network. We had no subscribers and we started no revenues. I thought that was appropriate. We were not actually paying players and fielding a team. We did the same thing in soccer, where we bought the media rights but we don't own any teams. RSNs, regional sports networks, are one of the hottest properties in media, because all they really have is the right to broadcast a team: hockey, baseball, not football. In LA, there are 8 regional sports networks, which I think is crazy. They're probably all covering the same event today. And so I think Leon's right. It is possible to strip out that piece which best fits what we do and leave what is often called the trophy piece to individuals, which could even be, and often is, someone from this industry.
Mm-hmm. So given it is a seller's market out there, the question I asked earlier is, what would it take for you to feel that, what would it take for valuations to come in? Is it a big sell-off in the public markets? Is it a move in interest rates? And what are your expectations in terms of rates?
Clearly, interest rates are a big factor. If interest rates go up a few hundred basis points, prices will come down and be more reasonable.
Do you see that happening?
My expectations aren't that that's going to happen in the foreseeable future. If you look at the Fed policies, I think Yellen will continue on what Bernanke was doing and maybe even be a little more liberal. So I don't think most people think that rates are really going to move up before the end of 15.
Before the end of 15.
And then you have politics and presidential race. So who knows? But I don't think it's going to happen in the next 18 months. So I think we are where we are, and we have to look at niches. As we talked before, energy is a good niche. Europe's an interesting niche.
Talk about it. Tell us about the shale revolution.
Well, I'm going to talk about Europe because we haven't talked about it. And I think the deleveraging of the banks over there is as real as the shale revolution is here. I think you have $1 trillion or more of assets, of euros, that have to come off the bank's balance sheets over there, and it is happening. And if you look at supply and demand, there aren't many players. You can count on 1 to 2 hands the players who have really dedicated teams, who have servicers on the ground. Now, this isn't necessarily private equity, it's more loans, many of them commercial loans, many of them real estate loans, but you're talking Spain, Ireland, the UK, maybe Italy now. There are very, very interesting opportunities if you can be a holistic solution provider to a lot of these banks. They're not out there with a for sale bargain signs, but again, if you can work with them and get back in terms things that'll help them on sticker price, there are debt returns on different credit instruments that you can get back in the high teens to low 20s today, which we think is a terrific opportunity. It's one of the reasons why, if you look at Apollo today, probably 2/3 of our assets under management are in the credit spectrum, and Europe's an important part of that.
And you can show slide 36 on this. Are you expecting to see more stimulus in Europe? Would that also help the situation? I mean, I guess Mario Draghi was out the other day basically saying, we may do QE, but not until the Fed finishes QE.
So, there's been a lot of capital flow into Europe over time, expecting what Leon is talking about to have happened 5 years ago, and it didn't happen. So Europe has gone much more slowly, and it's been a much better place for debt investing, as Leon was talking about, or like our Special Situations Group does, as opposed to the more vanilla, what you think of as private equity, because you're in a situation where the balance sheets aren't whole. When you're going to have debt at a discount, it's not a good place to be in equity by and large. The fringe markets have been more interesting. The Spains and Italys are more interesting than the Frances and the Germanys. But there still is a fair amount of capital. Not many people have both the equity and the capital expertise so that they can do the kind of analysis that needs to be done. But I think you can look forward to Europe being improving, but slowly. It's going to be low growth forever.
Let me ask you, David, when we were on the phone, we talked a little about the smaller fund, the growth fund that you also have at TPG, and you were very smart to invest in Uber, which has been a fantastic success. Still an owner there. What about Airbnb? What can you tell us about what's going on? And do you worry about these investigations? About people are worried about what goes on in the homes that are being offered, or is this just the realities of owning a hotel, or the realities of owning Airbnb?
Well, I'm not commenting specifically on Airbnb, which is, as you point out, another investment that our growth fund has made. You're seeing this technology disrupting all kinds of different businesses in all kinds of different ways, with all kinds of issues that people never even thought about, secondary issues about, can you really rent your home, or can you really operate a vehicle service without a taxi license, all these kinds of things. And these are two of dozens of companies that have the same kinds of issues. And what they have found out, I think, is you're better off asking for forgiveness than you are for asking for permission. Because what tends to happen is, again, I'm not referring to anybody in particular, but what tends to happen is you get users for whatever it is, and you have your own built-in lobby as opposed to the existing business when you start. So you've seen this happen in places like France, which is not notoriously friendly for innovation, where the customers have sort of outweighed the taxi drivers.
Before we wrap up, in the past few years, I've ended with a question for all of you, and I've said, what is your single best idea right now? You were all very close to the vest and unwilling.
Nobody has ever answered that question.
Very unwilling to share what your single best idea is for competitive reasons, I understand. So I have come up with another question, and I'm hoping that you don't let all of these people in the audience down. Okay. When you look at the markets, knowing that valuations have gone away from some and things look a bit expensive in some corners of the public market as well as private equity, what area of the market would you say is most expensive right now? Leon. What's something you're not even going to touch because it's just it's away from you?
Well, I can't say media and I can't say consumer
Why?
retail.
Because you got two guys buying it?
Exactly.
But that's what you feel?
No, it isn't.
He's just,
To me, it's no. I don't think I'm going to answer
Technology?
that. I don't think I'm going to answer that because who knows? There might be an opportunity in that field. It's a little bit like what Jonathan said that he travels.
You and I were
Yeah,
on
right.
He's not going to mention a
You're not going to
country.
name a country where you might be in 3 weeks.
Exactly.
I mean, a country, a sector. We talked about real estate investment trust, actually, when we were on the phone.
well, so I can't, unfortunately, I answered your question. I prepared for your question last year, not this year. So I can answer that one if you'd like.
Okay,
I think,
what's the big opportunity?
I think
What's your single
figuring,
best idea?
and it's not a big idea, but what happens is when you get the Fed doing things that they're doing, short end, long end, tapering coming down, it does tend to throw different markets out of whack. And to me, right now in the U.S., where we've seen the impact most and where it's impacting value is obviously a fixed income. What sort of strikes me, and I just got an example of two things. One thing that I think isn't properly valued is yield associated with public equities, not just from dividends, but from stock buybacks. So this is just timely. There's a company that just sold called National Vision. It operates stores within Walmart. Financing was put on it at 8 times EBITDA at a rate of 4.55%. That is variable, so it could go up, could go down, but it's variable. Okay, you can buy Walmart, the company that houses National Vision today, and you'll get a 2.5% dividend yield, and they're buying back stock such that you get 2.5% from the stock buybacks, cash from these stock buybacks, tax to capital gains rates. So you're basically getting 5% owning Walmart, or you can get at 8.5 times, or you can get 4.5% today owning National Vision at 8 times EBITDA. To me, that doesn't seem right. It doesn't mean that either of those is not going to work out. I don't really have an opinion, haven't looked at it closely enough. But to me, that's a sort of distortion that you can get from a market like this.
Jonathan, what about you? Are there things
Well,
that
actually,
are-
I wanted to ask you a question. What do you think the worst network is? You don't want to answer that.
The worst network. Wow.
I have an opinion, but I won't disclose.
So,
Go with the
Maria,
Russian one. Go with the Russian one.
because you could be there in a week. No, not a week, but at the expiry of your contract.
What?
No, if you said, look, the worst, we don't want to pick an industry we really don't like, because if other people decide they don't like it, prices fall, and all of a sudden it's interesting to us. Even newspapers at some
I
level.
think people are ready for an alternative. I think people are tired of chatter and talking about, all about me. And I think people are looking for alternatives to what we have in the marketplace today. And I'm all about diversification. And so I don't have a worse network to tell you, but I will say that I think that it's important for people to have alternatives and people to not only have soundbite situations, but actually analysis and perspective, longer interviews. And so that would be the reason that I left CNBC.
Oh, I thought that was an ill-disguised attack on the panel.
No. He asked me about a network specifically because I left CNBC.
Marie, well,
You guys, you
we'll
don't want to
talk-
answer questions. You want to compete with each other, and then you throw this question at me. I mean, I don't know what to say about it.
you've been asking us questions for years.
I thought this was my
we got
job.
to ask one.
She gets paid for it.
I actually just answered you. I actually just answered you.
You did. That
Okay,
was great.
so what is an area of the market that is overpriced?
Well, this says wrap.
I know, but we're all waiting on you.
And you have, and that's duct tape there. What's that doing there?
Well, I brought this in case David
If you don't
Martin
stop
got
answering the
inte-
question, you'll
got-
find out.
Got intemperate with
I-
some of his comments. I brought this for David.
Oh, okay.
No, you're not going to go there.
Actually, there are only a few industries in telecom and media that have literally disappeared, and you know, that usually what is a threat turns out to be complementary in some way. Pagers disappeared. That's one of the few, that whole industry. Newspapers, as we know it, could. So that's been our least favorite. We used to be in the business. It was one of our early sectors, and as configured, other than a New York Times or papers like that,
Franchise.
they could literally disappear.
Yeah.
As we know it.
Even though it's the content, I thought that was just
And that's
so highly valued.
fits your description about what people, what needs to be published, delivered in some form. That is threatened, and we all lose in some sense from that.
You're the only one who I hadn't asked. I don't know if you're going to answer, but is there an area of the market you would avoid, or is there a single best idea you'd like to share with us?
I can answer that very succinctly.
Yeah, no.
No.
Thanks, everybody.